out. Rima standing by now to take us through what Q4 looks like. Rima.
Well, this is turning out to be a disappointing quarter for Infosys. It's a miss on revenues, a miss on margins, and the FY24 guidance is coming in lower than what the street was anticipating. The markets were fearing a weak set of numbers, which is why the stock ended with a cut of 2.7%. But this is a much weaker showing compared to TCS as well. Let me run you through the numbers. Constant currency revenue growth has fallen by 3.2%. Yes, it's fallen by 3.2%. The most bearish estimate on the street was a minus 0.1%. The company has delivered a decline of 3.2%. Okay, the last time we had such a big decline in the revenues was in the COVID quarters. So minus 3.2% is the constant currency revenue growth. Margins also have fallen by 50 basis points. At 21%, it falls short of expectations of 21.5%. So minus 3.2% on the top line and margins declining by 50 basis points to 21%. Both these parameters are much weaker than what we were anticipating. The bigger problem is going to be the guidance for next year. The company is guiding for a revenue growth of 4 to 7%. Okay, this is, compared to our expectations of about 6 to 8% or even 5 to 7%. There are 2 points to this. One, the guidance is much lower than what the street was anticipating. And two, given the uncertainty, they have widened the revenue band. Typically, when they give you a revenue guidance, the band is 200 basis points because you want to account for some uncertainty. When you give a 300 basis points revenue band, that's 4 to 7%, it's accounting for a lot of uncertainty. So that's the miss in terms of the revenue performance. Margins too have come in lower than what the street was anticipating. Their EBIT margin guidance stands at 20 to 22%. Versus the CNBC-TV18 poll of 21 to 23%. Just to put it in context, in FY23, the margins were at 21%, which basically means they're not expecting margins to improve from here on. And here the key reason would be no operating leverage. If your revenues are not there, it's very hard to grow margins. So margins too have come in lower than what the street was anticipating. Salil Parekh, the CEO and MD, says, as the environment has changed, we see a strong interest from our clients for efficiency, cost and consolidation opportunities, resulting in a strong, large deal pipeline. We have expanded our internal program on efficiency and cost to build a path to higher margins in the medium term. We continue to invest in our people and in supporting clients. So the FY24 guidance is a miss. 4 to 7% revenue growth, margins at 20 to 22%. So there is no expansion in margins that they are anticipating. And just to, put it in context, this 4 to 7% growth will compare with the 15.4% growth that they've seen in FY23. So there is a sharp drop-off that we've seen. And also, the FY23 revenue growth of 15.4% is missing the company's guidance. The deal wins are pretty healthy, $2.1 billion, but this is lower than the deal wins that we had in the prior quarter. So this is an across-the-board miss, and it's an across-the-board very big miss. Mitul Shah, head of research at Reliance Securities, is now with us on the show. Mitul, I'm trying to find some silver linings that perhaps we can latch on to the order book number, where $2.1 billion is the deal wins announced by Infosys in Q4, which is lower on a quarter-on-quarter basis, but largely in line with their long-term average. But on all other parameters, on Q4, FY24 guidance, it's a big miss.
Yes, there is a big miss across the count. Even deal win is lower Q on Q, as well as it is much lower than Q2 numbers also. And revenue miss, instead of growth, it is coming decline. That is really a surprising, because in the company's geography-wise performance, Europe has done far better than our expectations. So problem is coming from North America. And even if we look at vertical-wise details, then there is a sizable decline in contribution from BFSI segment. So we can make out that the issue is from North America as well as BFSI segment within the entire space for the company.
Okay, I'm still trying to cull out the BFSI and the North America numbers, but just to put the minus 3.2% constant currency revenue growth, to put those numbers into context, even in the COVID hit quarters, the revenue growth decline was not as much. In Q4 FY20, which is the March quarter, which had about a 1 month or a 15-day impact of COVID, the revenues had fallen by minus 0.8%. In the following quarter, which was the most severe, the April to June period of 2020, in the immediate aftermath, the revenues for Infi had declined by minus 2%. Okay, so this minus 3.2% is much worse than what we had seen in COVID. And as I said, no one on the street anticipated such a large decline in their revenues. This has come in as an absolute shocker on the way down. For those of you who've just tuned in, even though we were bracing ourselves for a weak set of numbers after TCS's poor showing, Infosys numbers are really surprising on the downside. Constant currency revenue growth has fallen 3.2% on a quarter-on-quarter basis. The street was anticipating a modest growth. Margins have fallen by 50 basis points to 21%. Again, missing the mark. Their FY24 guidance is for a 4 to 7% growth. So on one hand, they have also widened their revenue guidance band. 4 to 7% compares with a 15.4% growth that they've delivered in FY23. And margins too. The street was hoping for some sort of a margin expansion because the supply side of the equation had started improving with lower attrition and fewer hires, but that doesn't appear to be the case. The company's margin guidance band stands at 20 to 22%, which compares with 21 to 22% that they had guided for in FY23. So this is turning out to be a big disappointment. Trying to get some more internal details. Mitul, do you have the BFSI numbers? If you could share it with us.
So BFSI vertical contribution is 29.3% compared to previous quarter. It was 30.5%.
Okay.
And prior to that, 31.5%.
Okay. And do you have some more numbers on attrition, and are there any other verticals which have seen a big fall or a big miss? Or is this only BFSI?
So now it seems that it is BFSI related major issue. And in terms of this employee addition also, this is a very important point to note that there is a negative employee addition, or there is an employee reduction to the tune of 3,000 headcounts. So despite that, there is a pressure on the employee cost side. And very interesting thing from this guidance as well as yesterday's TCS commentary, we should note that both the management, earlier few other management highlighted, January was decent or reasonably strong, but February and March has witnessed deterioration. So that means that still within the quarter, performance of 1 month was much stronger. And if we assume that similar trend to continue for next few months, then certainly next quarter would be a sizable deterioration on Q-on-Q basis from here on across the IT coverage.
Okay.
So that is a real challenge for next 2 quarters for the industry.
Okay, one more metric which does indicate perhaps that things are slowing down meaningfully is the hiring number or the increase in the headcount. And the total employee base has fallen by almost 3,500 employees on a quarter-on-quarter basis. One reason for that is because the companies have enough people on their bench. They had overhired maybe in the first half of the year when things were looking up, and now perhaps they don't need more people. But the second way to look at it is also that it's signaling a significant demand moderation, which is why the people who have stepped out, they're not looking to replace it. So the total employee headcount has fallen by 3,500, and this is one of the lead indicators of demand slowdown. Secondly, on attrition, yes, it's moderated quite significantly. The voluntary attrition is at 20.9%, which compares with 24.3% the prior quarter. So we have seen a fall of about 340 basis points in the attrition numbers on a quarter-on-quarter basis. The problem is really that the top line has, completely evaporated for the company, the growth in the top line, and that's the reason why, despite attrition coming down, the headcount coming down, margins for the company have fallen. The problem is predominantly the financial sector. BFSI has seen a modest growth of 0.4% on a year-on-year basis. To put it in context, the company's growth rate was 8.8%. Up until now, we were talking about the quarter-on-quarter numbers, but, Infi gives the vertical breakup or the business segment vertical breakup on a year-on-year basis. So 8.8% is the company average. Now, you need to reference all the vertical growth to that 8.8%. So BFSI is 0.4%, practically means no growth compared to the prior year. This is about 29% of the overall revenue. Another vertical which has seen a meaningful slowdown is communication, 11-12% of their revenues. That has seen a growth of just 0.3%. So communication has slowed down, and high-tech continues to remain very muted. High-tech has just seen lower than company average growth of 3.4%. North America is a slow vertical, and rest of the world as well has slowed down for them. And India business too has seen a fall of 7.1% on a year-on-year basis. So North America is weak. India is also fairly weak for Infosys this time. Week showing Shireen trying to get more details, and I think the management commentary will provide more clarity for the negative growth that we've seen in Q4 and what's led to such a weak guidance.
Absolutely. And we are a couple of minutes away, Rima, from the management speaking to us. So we will, of course, wait to see what they have to say. But, I was just listening into what Mitul was saying. And that really, takes me back to the conversations that we were having in January, where most of the tech CEOs that we spoke to said, look, so far demand seems to be holding up. And it clearly seems that Feb and March have turned out to be a very different story. And as you were pointing out, it is BFSI which is hurting both for TCS as well now for Infosys, and this is going to be a pocket of pain to watch out for, Rima.
No, absolutely. What TCS said was very telling. He said that at the beginning of the quarter in January, we were penciling in a pickup in North America. Then February and March happened, the regional crisis, the regional banks crisis in US. Banks were in a rush to conserve capital. Discretionary projects were put on hold. All non-essential projects were paused or deferred for some time, which is why the revenues completely dried up. So if you were anticipating a revenue growth of 1.5% to 2%, as Rajesh was telling us, and these were our costs, they were expecting to make a margin. But now the revenue fell down because discretionary projects were, put on hold. They didn't get that anticipated revenue, but the costs remained where they were, and margins turned out to be absolutely flat. And in the case of Infosys, margins have fallen. So BFSI projects appear to have been hit. Discretionary projects have been put on hold, and there is a spillover into other sectors as well, as TCS said. TCS also flagged off manufacturing, auto. In the call yesterday, they even spoke about retail and high-tech and turning out to be a bit cautious. So it's largely BFSI, but there is always a ripple effect when the consumer sentiment turns south.
Yeah, absolutely. And we will, of course, get more color from the management as we speak with them in a few